Something extremely important is happening in the financial markets right now. And whether you hold XRP, Bitcoin, or no crypto at all, this is something you need to understand clearly. What we've been witnessing over the last several weeks is not normal price action. It isn't organic volatility. It's not being driven by fundamentals, adoption headlines, or standard macroeconomic releases. What we're seeing instead is structured, repeated, mechanical behavior that strongly points to manipulation, and that behavior has been intensifying as we move closer toward 2026. Going into the early morning hours of December 28th, the crypto market appeared to be showing a healthy push to the upside. Bitcoin surged back toward the 90,000 level. Altcoins followed along, momentum looked convincing, and for a moment it felt like a genuine breakout attempt. Then, almost instantly, the entire move was erased. A sharp and aggressive sell-off swept across the market, wiping out gains not only in Bitcoin, but across the broader crypto market. And this wasn't an isolated incident. This same pattern has been repeating itself again and again. If you only look at a 24-hour chart, it doesn't immediately appear alarming. It looks like choppy, sideways movement with some volatility. Nothing that seems out of the ordinary. But that short-term view hides what's really going on. When you zoom out even slightly, a very different picture starts to emerge. You see repeated spikes to the upside, sometimes $10,000 or more on Bitcoin, followed almost immediately by violent sell-offs. Build the position, dump it. Build again, dump again. Over and over. On the 4-hour time frame, this behavior becomes impossible to ignore. Massive wicks, huge candles, $3,000, $4,000, even $5,000 moves happening within a single 4-hour period, only to be completely reversed. What matters most here isn't just the size of these moves, it's their consistency. This pattern has been accelerating ever since late November. Markets do not behave like this naturally for weeks at a time. This isn't random. This is classic leverage hunting. Market makers are systematically targeting over-leveraged positions on both sides, longs and shorts alike. They're using liquidity gaps and low volume periods to their advantage, and retail participants are getting absolutely crushed in the process. This is exactly why understanding positioning matters far more than reacting to headlines. The people who consistently do well in environments like this aren't reacting emotionally. They're prepared. A clear example of this behavior played out over the weekend. Bitcoin pumped roughly $3,000, pushing above 90,000 and liquidating over $100 million in short positions late Sunday. Then, almost on cue, Monday morning brought a sharp reversal. Bitcoin dropped around $2,700, liquidating another $40 million in long positions and completely erasing the prior move. There was no news, no catalyst, no fundamental trigger, just pure positioning warfare. Timing matters here as well. These sell-offs tend to occur during the same windows, roughly between 9 and 11 in the morning Eastern Time, day after day. Weekend price action has always been unreliable in crypto. Liquidity is thinner, moves are easier to influence, and price often becomes disconnected from fundamentals. Experienced market participants treat weekend moves with extreme caution, and for good reason. Now, here's where things start to become even more dangerous. Alongside this manipulation, we're also seeing a surge in fake narratives and low credibility accounts injecting fear and hype into the market at exactly the wrong moments. Over that same weekend, gold and silver were rallying aggressively, which immediately triggered speculation that something was breaking behind the scenes. Then a rumor began circulating, fueled by a screenshot claiming that a systemically important U.S. bank had failed overnight after missing a margin call tied to silver futures. The post claimed the Federal Reserve was forced to inject an additional $34 billion through emergency repo operations. The timing lined up perfectly with the volatility, and that's all it took to spark panic. But almost no one stopped to examine the details. Prediction markets exploded, showing odds of a U.S. bank failure spiking above 70%. Crypto sold off sharply. What most people missed was that the entire spike in those prediction markets was driven by less than $1,000 in total volume. A handful of small bets created the illusion of overwhelming consensus. There were no official filings, no confirmed Federal Reserve statements, and no verification from the New York Fed. Community notes eventually clarified that the story was completely fabricated, but by then, the damage was already done. Behind all of this noise, something far more important is actually happening. The Federal Reserve is injecting liquidity again. This part is real. This part is verifiable. And this part matters more than anything else currently unfolding in the market. Since early November, the Fed has conducted multiple large overnight repo operations. On November 1st alone, nearly $30 billion was injected. In December, additional injections followed, $13.5 billion, then $16 billion, then another $25.9 billion. By the end of the month, well over $29 billion had been added in December alone. These are not permanent quantitative easing programs, but they are not meaningless either. Repo operations exist to relieve short-term funding stress, smooth overnight rates, and keep reserves stable, especially during periods when banks adjust and window dress their balance sheets. When these operations start increasing in both size and frequency, it tells you something is under pressure. Is the financial system breaking tomorrow? No, but something is strained. And historically, when liquidity conditions loosen, even temporarily, risk assets tend to benefit. Crypto has always thrived on liquidity. This is where context becomes critical. Right now, many people are saying crypto looks weak because Bitcoin isn't moving. But that argument ignores history entirely. We've seen this exact setup before. After the March 2020 crash, the Federal Reserve injected massive liquidity into the system. The first assets to respond were gold and silver. Gold rallied from roughly $1,450 to over $2,000 by August of that year. Silver surged from around $12 to nearly $29. During that entire move, Bitcoin did almost nothing. For nearly 5 months, Bitcoin chopped sideways between $9,000 and $12,000. People called it dead. They said it was broken. They said the cycle was over. Then gold and silver topped and capital rotated. From August 2020 to May 2021, Bitcoin went from $12,000 to nearly $65,000. Altcoins followed. The total crypto market capitalization increased nearly eightfold. That rotation was the key. Fast forward to today, and the parallels are difficult to ignore. We recently experienced another major liquidation event in October, similar in structure, though not in scale, to March 2020. Since then, gold and silver have been surging again, while Bitcoin has mostly moved sideways. The difference this time is that liquidity is not the only catalyst. We also have structural changes. Rate cuts are expected. Regulatory clarity is improving. Banks may receive supplementary leverage ratio exemptions, increasing balance sheet capacity. Spot crypto ETFs already exist, with more likely coming, especially for altcoins. Large asset managers now have frictionless access to the crypto market, and policy shifts are often priced in long before they're officially announced. This is not a bearish environment. It's a compression phase. And compression phases are exactly where positioning matters most, because the biggest gains are never made during hype. They're made during confusion, boredom, and disbelief. That's why understanding these cycles, these rotations, and these liquidity signals is no longer optional. It's the difference between reacting emotionally and positioning strategically. Coming back to the market structure, the reason gold and silver moving first matters is because they historically act as early signals, not endpoints. They absorb liquidity first, they draw attention first, and once they pause, that liquidity doesn't disappear. It looks for higher beta opportunities. Crypto is higher beta. Bitcoin doesn't usually lead at the very start of liquidity cycles. It accelerates after confirmation. That's why sideways action right now is not the beginning of a bear market. It's the calm before rotation. The people who understand that aren't panicking. They're preparing, because when this shift happens, and it always does, it happens faster than most people expect. Markets don't move when the story becomes obvious. They move when positioning is asymmetric and conviction is low. Right now, sentiment in crypto is fractured. Some people are euphoric, convinced every dip is a gift. Others are exhausted, convinced every pump is fake. That emotional divide is exactly what creates opportunity. The manipulation we're seeing isn't designed to destroy the market. It's designed to exhaust participants. Repeated spikes and sell-offs condition traders to chase late and sell early. Over time, confidence erodes, position sizes shrink, and people exit trades they never should have left. Market makers don't need price to collapse to win. They just need participants to give up. And that's why leverage is being targeted so aggressively right now. Every time Bitcoin pushes into a key level, open interest spikes. Retail piles into longs or shorts with tight stops and high leverage, convinced that this time is different. Then liquidity is pulled. Price is shoved violently in the opposite direction, and those positions are wiped out within minutes. The cycle resets and the process repeats. When you zoom out, this behavior aligns perfectly with a broader macro backdrop that remains unresolved. Yes, the Federal Reserve is injecting liquidity, but it's doing so cautiously and tactically, without signaling full-scale easing. That uncertainty keeps markets range-bound, volatility elevated, and gives institutions the ability to operate patiently. Another critical element most people overlook is how regulation and structure are changing the crypto market itself. This is not 2017, and it's not even 2020 anymore. Institutional participation fundamentally changes how price behaves. Algorithms dominate order flow. ETFs alter demand mechanics. Custodial access removes friction for large pools of capital. That doesn't eliminate volatility. It concentrates it around key levels. That's why we're seeing sharper wicks, faster reversals, and more violent liquidations. The market is deeper, but it's also far more efficient at punishing poor positioning. And right now, poor positioning is everywhere. At the same time, there's a growing disconnect between on-chain fundamentals and price action. Long-term holders are not distributing at meaningful levels. Exchange balances remain historically low relative to prior cycles. Wallets holding significant amounts continue to accumulate during drawdowns. None of this aligns with the idea that the market is topping. Instead, it points to a market digesting liquidity shocks and waiting for confirmation. And confirmation doesn't come from headlines. It comes from rotation. Gold and silver moving first isn't random. It's capital seeking safety during uncertainty. Once that uncertainty stabilizes, even slightly, that capital doesn't vanish. It reallocates. And when it reallocates, it looks for assets with convex upside. Bitcoin remains the gateway, but this cycle, the downstream effects are larger. Altcoins tied to infrastructure, payments, tokenization, and real-world assets are positioned very differently than in previous cycles. XRP sits directly in that conversation, whether people like it or not. The market doesn't require universal belief. It only needs marginal demand. Another common misconception right now is that sideways price action means time is being wasted. In reality, time is being used. Consolidation is how markets build energy. The longer and more frustrating the range, the more violent the eventual move tends to be. This is why experienced participants focus less on short-term candles and more on structure. If you look at Bitcoin's behavior following major liquidation events historically, a pattern emerges. Sharp drop, extended chop, false breakouts, then expansion. We're still firmly in the chop phase, and chop phases are where most people mentally exit before the real move even begins. This is where patience becomes a weapon. Not passive patience, but informed patience. Knowing what you own, why you own it, what conditions would invalidate your thesis, and what conditions would confirm it. The Federal Reserve does not need to announce quantitative easing tomorrow for crypto to move. Markets front-run policy. They always have. Rate expectations, liquidity expectations, regulatory expectations all get priced in long before the headlines catch up. By the time the average person feels comfortable, the opportunity has already passed. This is how cycles are missed. Comfort always comes at a premium. Early positioning is uncomfortable by design. It feels boring. It feels frustrating. It feels like nothing is happening until suddenly everything happens at once. That's why comparing this environment to mid-2020 matters. Not because history repeats perfectly, but because behavior rhymes. The disbelief, the manipulation, the sideways grind, the rotation signals, they're all present. The difference now is scale. There is more capital watching crypto than ever before. More on-ramps, more products, more narratives waiting for ignition. When liquidity truly expands, not just through short-term repos, but through sustained easing, reflexivity will be stronger. Markets won't wait for everyone to be ready. This is also why blindly trading every move is a losing strategy right now. Overtrading in manipulated conditions is exactly what larger players want. Strategic positioning beats constant reaction. It always has. The next phase of this cycle won't announce itself politely. It will start quietly, then accelerate faster than most expect. Breakouts will be violent, pullbacks will be shallow, and sentiment will flip almost overnight from boredom to regret. The people who benefit won't be the ones chasing green candles. They'll be the ones who use this period to build conviction, manage risk, and understand the bigger picture. That's the real takeaway from everything happening right now. Not that the market is broken, not that crypto is dead, but that the game has evolved, and those who refuse to adapt will continue to get shaken out. This environment does not reward impatience or emotional decision-making. It rewards preparation. It rewards discipline. And it rewards those who understand how manipulation, liquidity shifts, and macro transitions actually work together. Right now, we are in a phase that feels intentionally uncomfortable. Price goes nowhere. Narratives constantly change. Confidence gets tested. And that's not accidental. That's how markets force weak positioning out before the next expansion phase begins. What most people fail to realize is that markets don't move when the story becomes obvious. They move when positioning is asymmetric and belief is fractured. And that's exactly where we are today. Some participants are convinced every dip is an opportunity. Others are convinced every pump is fake. That split in sentiment is not a warning sign. It's fuel. It creates the conditions where larger players can accumulate quietly while retail debates narratives on the sidelines. The repeated manipulation we're seeing is not designed to collapse price. It's designed to wear people down. Repeated spikes and sell-offs train traders to react emotionally. Chase late, exit early. Over time, that conditioning erodes confidence, reduces position sizes, and forces people out of positions they should have held. Market makers don't need price to crash to win. They just need participants to lose conviction. And leverage is the fastest way to make that happen. That's why every time Bitcoin approaches a major support or resistance level, open interest explodes. Retail piles into high leverage longs or shorts with tight stops. Convinced the breakout or breakdown is guaranteed. Liquidity gets pulled. Price snaps in the opposite direction. Positions are liquidated, and the cycle resets. This process repeats until participation is exhausted. Zooming out, this aligns perfectly with a macro environment that is still unresolved, still cautious, and still operating in ranges. At the same time, the structure of the crypto market itself continues to evolve. Institutional involvement has changed the way price behaves. Algorithmic trading dominates order flow. ETFs alter demand dynamics. Custodial infrastructure removes friction for large capital. Volatility hasn't disappeared. It's become more concentrated, faster, sharper, more punishing for poor positioning. And right now, poor positioning is widespread. There is also a growing disconnect between sentiment and fundamentals. On-chain data does not support a market top. Long-term holders are not distributing aggressively. Exchange balances remain relatively low. Large wallets continue accumulating during drawdowns. That behavior is inconsistent with panic or distribution. It's consistent with consolidation and preparation. Gold and silver moving first remains a critical signal. They are not the destination, they are the signal. Capital seeks safety during uncertainty. Once that uncertainty stabilizes, that capital reallocates toward assets with higher beta and greater upside. Crypto fits that profile. Bitcoin remains the gateway, but downstream assets tied to infrastructure and payments are positioned differently this cycle. XRP is part of that structural shift, whether it's popular to say or not. Markets don't need unanimous belief. They only need incremental demand. Sideways action does not mean time is being wasted. It means time is being used. Consolidation builds energy. The longer the range, the more forceful the eventual move. That's why experienced participants focus less on short-term noise and more on structure, liquidity, and rotation. Chop phases are where most people mentally exit right before expansion begins. The Federal Reserve does not need to announce anything dramatic tomorrow. Markets front-run policy. They always have. Expectations get priced in long before headlines confirm them. By the time conditions feel comfortable, the opportunity is gone. Early positioning never feels good. It feels boring and frustrating until suddenly everything changes at once. This is why blindly trading every move is a losing strategy right now. Overtrading benefits larger players. Strategic positioning beats constant reaction. Always has. The next phase will begin quietly, then accelerate faster than most expect. The people who benefit will be those who prepared during uncertainty, not those who chased confirmation.